Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone. And welcome to another deep dive. This is where we take, a whole stack of information today. It's coming from reports by CNBC and Bloomberg, and we try to boil it down to the really key stuff for you, our mission today. To unpack this complex picture, global market moves, trade dynamics shifting around, plus some big sector-specific news. Get ready for some, frankly, surprising facts and insights that should help you cut through all the noise. Okay, let's unpack this. Right, let's kick things off with the overall market picture. And, well, it looks like a story of broad declines across Asia Pacific today. Most major markets there traded lower. We saw South Korea's Kospi dip nearly 1%. Australia's S&P 200 fell almost 0.8%. And mainland China's CSI 300 also closed down a bit. Even Japan's Nikkei 225 ended, well, basically flat. Tiny dip. India's Nifty 50, though, one of the very few bright spots, managed a marginal gain, kind of bucking the trend.
Yeah, and what's intriguing here, even with that overall dip, is how some of these moves seem directly linked to the developing U.S.-Indonesia trade deal. Our sources are showing President Trump announced a preliminary agreement, and it notably includes a 19% tariff on Indonesian exports to the U.S.
19%. That's quite a step back from the 32% he was threatening just last week, right?
Exactly, a significant pullback. And for the U.S. side, it apparently means tariff-free access into Indonesia. Now, Indonesia's President Prabowo Subianto, he confirmed a very good call with Trump, but hasn't publicly confirmed the specific details, the tariff rate. Although Indonesian stocks, the Jakarta Composite, did climb just a little bit, 0.26%, so maybe a sign.
So this Indonesia deal, it almost feels like markets are becoming a bit, ho-hum about these tariff threats. Is that fair? It's a curious reaction, especially when President Trump himself suggests markets are fine with tariffs now, that they see the benefits.
Right, but sources on Wall Street, they tell a different story. They're attributing this resilience to, well, they call it taco.
Taco.
Yeah, Trump always chickens out. That's the theory. Or, alternatively, maybe it's just easing tensions elsewhere, like with China, that's calming nerves.
But that ho-hum reaction, is it resilience? Or is something else going on? Are investors maybe underplaying the risk here?
That's the real question, isn't it? If markets just shrug off these immediate threats, are they missing the bigger picture, the long-term drag? We've heard warnings about complacency from figures like Jamie Dimon at JP Morgan, Tim Urbanovich at Innovator Capital Management. He put it pretty bluntly. He said, essentially, the destination is higher tariffs, and I don't think investors have digested that yet.
So the underlying trend is still towards more tariffs, even if individual deals get walked back a bit.
It seems that way. President Trump is even signaling, letters are coming soon for smaller countries with tariffs a little over 10%. And then you look at South Africa. Their central bank chief, Lesetja Kganyago, warned Trump's 30% tariff set for August 1st could put maybe 100,000 jobs at risk.
Wow. 100,000 jobs?
Yeah, particularly in agriculture and autos. It's a huge potential impact that kind of gets lost in the daily headlines sometimes.
It definitely seems the market might focus on the immediate chicken out rather than the, cumulative economic weight of all this. And this ties right into another key indicator, U.S. inflation. The latest CPI numbers for June, they hit a 4-month high, up 2.7% annually.
Right, and core inflation, stripping out food and energy, that rose 0.2% month on month. Slightly below expectations, actually.
But even though the numbers met expectations, the fact that, as one analyst put it, downbeat expectations were realized still weighed on stocks.
Yeah, and Matthew Ryan at eBury suggested Trump's tariffs practically confirmed. They pushed up consumer prices in June.
So a direct link being drawn there. Hard to ignore, right? Okay, let's pivot. The tech sector. Because there's a development here that really jumped out at me. A big shift, it seems, in the U.S. stance on tech exports to China. NVIDIA announced it expects to resume sales of its H20 AI chips to China soon. This follows a U.S. reversal on export controls.
And AMD, their big rival, made a similar announcement. That's huge news.
Huge. NVIDIA's stock jumped 4% on this, and it helped push the Nasdaq to a record high yesterday.
What's really telling, though, isn't just the stock reaction. It's NVIDIA CEO Jensen Huang's perspective. He's been, well, remarkably consistent and vocal. He's been praising China's AI efforts, calling models like DeepSeek and Baidu's Ernie Bot world-class.
Really? Praising them publicly?
Yeah. And he's also lauded their open-source approach to AI, calling it a catalyst for global progress, even essential for AI safety, he argues. Huang's argument has always been that U.S. restrictions are basically counterproductive. They risk handing the massive Chinese market over to local players, like Huawei.
So this policy reversal, it sounds like it's part of bigger talks.
Reportedly, yes. part of broader U.S.-China negotiations. Maybe China accepts higher tariffs elsewhere, cooperates on rare earths, in exchange for this tech access. It suggests economic pragmatism might be winning out, at least on this front.
But as you'd expect, it's not without controversy. We're hearing that many China hawks in the administration and on Capitol Hill were apparently shocked. Privately fuming is the phrase used.
Understandable concern. They worry about an AI arms race, about keeping advanced AI out of the hands of the Chinese Communist Party.
And the House Select Committee on China plans to ask for clarification, apparently. So definitely a delicate balance being struck.
And if you connect this to the bigger picture, it kind of explains why we're seeing foreign investors actually returning to Chinese AI startups. You've got Beijing-based BI Capital raising an $800 million fund. Future Capital raised a record $210 million for a U.S. dollar fund.
So money is flowing back in.
It seems so. Partly spurred by things like DeepSeek's disruption, partly by a strong Hong Kong IPO market, which is actually on track to beat Wall Street this year for funds raised. And get this, ByteDance, TikTok's parent company, its private valuation has apparently surged. Started the year around $245 billion, now maybe $340 billion.
Wow.
Yeah, strong demand for its shares. It's acting almost like an AI ETF for investors wanting China AI exposure.
Okay, now for something completely different. The wild ride in crypto regulation this week, it started with, well, a pretty major blow. Several crypto regulation bills, backed by President Trump, failed to clear a key procedural vote in the House yesterday.
Right. 13 Republicans actually voted with Democrats to block it. The vote was 196 for, 223 against.
And the market reaction was immediate. Bitcoin fell below $117,000, pulling back from that recent record over $120K.
Yep. And crypto stocks like Riot Platforms, Coinbase, they slid too.
But then, just hours later, a complete turnaround.
A dramatic reversal is right. President Trump announced that those same Republicans who blocked the bills, they changed their minds after a White House meeting. He says they now have the votes to move forward. He's calling the legislation the Genius Act.
Genius Act. Okay, well, it certainly shows how quickly things can change in Washington, especially around crypto.
And what's really interesting is how Wall Street is positioning itself amidst all this back and forth. You see major banks pivoting towards stablecoins.
Yeah, I saw that. Jamie Dimon at JP Morgan, who's always been pretty skeptical of crypto.
Right, him. And Jane Fraser at Citigroup both basically said they're going to get involved in stablecoins or are looking at issuing their own city stablecoin. They're anticipating regulatory approval.
Bank of America said something similar too, right? They'll consider it once legislation passes.
Exactly. The takeaway seems to be, give us clear rules, even if they're strict, and we're willing to play in this sandbox.
So why stablecoins specifically? What's the appeal for these big banks?
Well, proponents see them as, a refuge from crypto's wild volatility, since they're typically pegged to the U.S. dollar. Plus, they offer near-instant settlement for cross-border payments, potentially wider access to the dollar itself.
Though right now, they're mostly used for crypto trading, aren't they?
Overwhelmingly. About 88% of stablecoin transactions are for settling crypto trades, only around 6% for actual payments. But the proposed legislation, it would require issuers to hold reserves in cash or treasuries, undergo audits, publicly disclose holdings, all without paying interest.
That sounds like the kind of framework banks would need.
Precisely. It could legitimize their involvement and maybe, just maybe, help stablecoins move beyond just the crypto world.
Okay, let's shift gears again. Commodity markets. Gold and silver have been fascinating. Gold prices still on a strong run, trading near, what, $3,340 an ounce? That's up almost 27% this year alone.
Yeah, powerful move. Fueled by a mix of things, right?
Yeah.
Geopolitical worries, maybe less confidence in other safe havens, money flowing into ETFs. And a big one, central banks are buying, significant central bank buying.
And there's a really interesting trend within that central bank buying, isn't there, about buying local gold.
Absolutely fascinating. The World Gold Council's latest survey shows more central banks are buying gold directly from mines within their own borders. 19 out of 36 surveyed are doing it now. That's up noticeably from 14 out of 57 last year. And 4 more are thinking about it.
Why the shift? What's the advantage?
Couple of key reasons. First, it's often cheaper. They can sometimes negotiate a slight discount compared to international prices. Second, as Nikki Shields at MKSP-MP noted, it supports local industry, local jobs.
Right.
And crucially, it lets them build up reserves using their own local currency instead of spending precious foreign exchange reserves like U.S. dollars.
Which countries are doing this?
We're seeing it in places like the Philippines, Ecuador, Colombia, Tanzania, Ghana, Zambia, Mongolia, quite a diverse list. Now, there are challenges. Refining gold to the international standard, the London Good Delivery or LGD standard, costs money. And there can be reputational risks with, say, artisanal mining. But experts like Xiaokai Fan at the World Gold Council argue central banks can actually use their buying power to help formalize those supply chains, clean them up. It's a potentially powerful tool.
So gold strong, central banks are buying locally. But interestingly, Citigroup has a slightly different view on silver.
Yeah, they're actually quite bullish on silver right now. They expect it to rally beyond $40 an ounce in the coming months. They've raised their 6 to 12-month forecast to $43. They cite tightening physical supply and strong investment demand.
And silver's actually outperformed gold this year, hasn't it?
It has, up 31% year-to-date versus gold's 27%, so it's had an even stronger run lately. And Citi even suggested gold's peak might be in. They forecast a potential drop below $3,000 next year.
Wow, okay. So a potential divergence there between the two precious metals, according to Citi. All right, let's drill down now from the macro and commodities into some specific company earnings. It gives you a real sense of how businesses are coping. It's been busy. On the positive side, the big banks, JP Morgan Chase, Citigroup, Wells Fargo, they all reported Q2 results that beat expectations.
And Goldman Sachs is expected to report strong numbers too. Analysts are looking for around $9.53 per share on almost $13.5 billion in revenue. And interestingly, analysts suggest they've actually benefited from the market volatility caused by a ledger. Guess what? President Trump's tariff policies.
So the volatility helps their trading desks, even as the tariffs might hurt other sectors. An interesting feedback loop.
But then you get the other side of the coin. Look at ASML, the big Dutch chip equipment maker. Hugely important company. Their shares dropped over 6%. And this was despite beating Q2 booking estimates.
So why the drop?
They warned they might not hit their growth targets in 2026. And the reasons cited: geopolitical uncertainty and, yes, tariff headwinds.
So there's the direct impact, clear as day.
Exactly. Some banks might thrive on the volatility, but companies like ASML feel the direct hit from the policies causing it. Another surprise fall: Pop Mart International, the Chinese toy maker, their shares tumbled over 6%.
Even though they put out a bullish forecast, I saw they expected profits up like 350%.
Right. Huge forecast. But analysts think the negative reaction is down to investors being conservative about future sales growth. Suggests maybe the market is still cautious, despite strong current numbers.
And just quickly on a few other movers, Global Payments was up about 5% after an activist investor increased their stake.
Right, pushing for changes there likely. Omnicom Group gained over 2% after beating estimates.
But on the downside, Hancock Whitney slid over 3%. J.B. Hunt Transport Services also pulled back over 3% on earnings misses. So a real mix out there. Okay, final start for today. Japan. There's a specific story unfolding there related to the strengthening yen. It's hitting the luxury goods sector.
Yeah, Richemont, the Swiss luxury group that owns Cartier, they reported a 15% year-on-year decline in Japan sales for their fiscal first quarter. That's at constant exchange rates.
15% drop, that's significant and quite a reversal from last year, right?
A massive reversal. Same quarter last year, their revenues jumped 59%. That was driven by the weak yen back then, which fueled a huge surge in tourism and luxury spending, especially from Chinese shoppers. Now the yen has strengthened in the first half of 2025, and, well, it's clearly put the brakes on that trend. Shows how much currency swings matter for certain sectors.
And this links into broader questions about Japan's economy, particularly its bond market.
It does. Japan's 10-year bond yield hit 1.59% yesterday, highest since 2008, and the 30-year yield hit a record high, 3.21%.
Why the move higher in yields?
It's being attributed mainly to concerns about government spending, potential budget cuts down the line. It reflects this unique pressure point Japan faces, grappling with its own fiscal situation within the wider global economic context.
Wow. Okay, so putting it all together, this deep dive today really highlights how interconnected everything is, doesn't it? You've got trade deals influencing market sentiment, inflation linked back to those tariffs, tech regulations shifting dramatically, central banks changing their gold strategies. Every piece really does affect the others.
It really makes you consider, how all these seemingly separate daily headlines actually weave together. They form this much larger story about global economic shifts, about power dynamics, and about what's really driving market sentiment beyond just the surface numbers.
Well, we hope this deep dive has given you some valuable insights, maybe sparked some new questions for you to explore further. Thank you for joining us for this look at Wednesday's major financial magazine headlines. We'll see you all tomorrow morning with new headlines from major financial magazines.